The macroeconomy is the aggregation of all economic activity and the economic decisions that are made by all of a nation's participants. When studying the macroeconomy, two major areas of focus are measuring and understanding the factors that contribute to the sustained economic growth and maintenance of a nation's standard of living. In every economic exchange, the seller receives the same amount of money that the buyer spends. Therefore, we can approach the health assessment of the economy by analyzing both expenditures and income. We measure the economy using monetary values as our measuring stick. However, our real interest is in the productivity of the economy and the distribution of economic benefits to the population. Resources, goods, and services are exchanged for money payments as shown in the circular flow diagram. This diagram illustrates the interdependency of buyers and sellers in a market economy. All of the resources of production are owned and sold or rented to businesses through the factor markets. The factor markets are transactions in which businesses buy resources. The resources of production are combined together in various amounts and offered for sale in the product market. Product market transactions are where households buy goods and services. Entrepreneurs have the ability to select and substitute resources to produce goods and services consumers demand in the least cost method of production. For example, in digging a construction trench, the entrepreneur may hire dozens of workers with hand shovels when wages are relatively low, but they will hire fewer workers and employ a backhoe to dig the trench when the cost of several workers is greater than the capital cost. We know that the economy will endure fluctuations of expansion and contraction. Our economic history documented the Great Depression of the 1930s and the Great Recession of 2007 to 2009. The financial effects of the 2007 recession caused home prices to fall approximately 30% on average from their mid-2006 peak to mid-2009. The S&P 500 index fell 57% from its October 2007 peak to its trough in 2009. The net worth of U.S. households and nonprofit organizations fell from a high of $69 trillion in 2007 to the trough of $55 trillion in 2009. Because consumer spending was severely limited throughout much of 2020 with the closure of many businesses, real GDP growth compared to prior years fell by 31.4%, far greater than the Great Recession. Prior to the pandemic, the U.S. economy was very healthy with an unemployment rate at a 50-year low and a targeted gross domestic product annual growth rate of 2 to 4%. The driving force of the U.S. economy is consumer spending, which is about 70% of GDP. Unemployment increased to 14.7% in the early part of 2020, and although the rate fell in successive months, today it stands at 6.7% nationally. Measuring these economic conditions is essential for businesses, households, and government to help understand the continuing economic changes and to develop plans and policies to navigate the business cycles. After observing the economic trends, we want to quantify and test our observations by measuring and comparing economic indicators. The National Income and Expenditure Accounting is a system consistently used for this purpose. The most referenced measurement of an economy is the gross domestic product, commonly referred to as GDP, which is the total value of all goods and services produced in an economy in a period of time. The total market value is simply the total quantity of new production multiplied by their respective market prices. Total income is the yearly amount earned by the nation's resources or the factors of production, including labor's wages, rent for land resources, interest payments for the use of capital, and profits received by entrepreneurs. Our definition of GDP includes the term final goods and services. This limits the accounting to those goods and services that are sold to the final purchaser. Resources sold to producers and used in the creation of final goods are known as intermediate goods and are not used in the GDP determination. Counting intermediate goods leads to double counting the cost of the final good. The price of newly produced trucks includes the cost of producing steel for the body, leather for the seats, and rubber for the tires. Summing up the cost of each intermediate transaction inflates the GDP. There are numerous transactions that occur that have nothing to do with the final goods and services being produced. For example, financial transactions such as securities, stocks and bonds, and interest. Transfer of second-hand goods. These goods have been produced in previous years and included in previous year GDPs, and so they are not included in the current year gross domestic product. Other transactions that are not included in the current year GDP are household production, things we do around our own houses, and legal and illegal underground transactions. As mentioned before, there are two primary approaches to national income accounting: the expenditure approach and the income approach. The expenditure approach adds the dollar value of the current market prices for all goods and services. The income approach measures GDP by adding up all of the components of national income, including wages, interest, rents, and profits. The components used in the expenditure approach are consumer expenditures, investment expenditures, government expenditures, and net exports. Consumer spending has been the largest component of GDP accounting for much of the last century. It accounts for approximately 70% of the nominal GDP and is divided into three categories: durable goods, non-durable goods, and services. This component, when compared to income, shows how much money households spend on new final goods and services. It shows how much is being spent and how much is being saved. Gross private investment measures the amount that companies spend domestically on buying new equipment and replacing inventory. Domestic investment is also referred to as business capital expenditures. While the investment percentage of GDP is much smaller than consumer spending, it is critical to the continued growth of the economy. When firms invest in new production equipment and facilities, they contribute to the overall productive capacity of the economy. If the overall investment in capital equipment decreases from one year to the next, and the existing capital equipment continues to depreciate or wear out, the nation's economy will not have the capability to produce sufficient goods and services to maintain and grow a healthy economy. Federal expenditures totaled $1.49 trillion, with national defense making up $887 billion of those dollars. State and local government accounted for $2.3 trillion. Dollars spent in this category are for equipment, infrastructure, and payroll. Many economists argue that government spending is an essential component of GDP and should increase during a recession to balance out the reduction in consumer spending and the reduction in investment. Net exports is the component that is calculated by subtracting the total value of imports from the value of exports within the economy. During the decades following World War II, the United States was a net exporter to the world. In recent decades, however, this component of GDP has been a negative number as imports have outweighed exports. Graphically, GDP can be illustrated by adding the components: consumer spending, private investment, spending by government, and net exports vertically. The vertical axis measures the total dollar value of all spending within the economy. Comparing the changes in the total GDP each month provides critical information on the spending and income trends. Businesses and government agencies that track these trends can then use the information to develop strategies and policies to mitigate extreme shifts in the economy. The most recent trend information shows that real gross domestic product increased at an annual rate of 33.1% in the third quarter of 2020, following a real GDP decrease of 31.4% in the second quarter. While the GDP is the most prominent macro measure of the economy's health, there are several other measurements that provide more specific details to facilitate an understanding of the changes in the macroeconomy. Net domestic product focuses on the productivity of the economy against the depreciation of capital equipment. Maintaining the capital stock of productive equipment is essential for continued economic growth. Expressing the net domestic product using our mathematical formulas is shown here as a progression of functions. Domestic investment minus an estimate of the wear and tear on existing capital stock shows us the change in capital stock over a 1 year's period of time. The alternate method of national income accounting is the income approach, where all of the income derived from the sale or rent of production resources, land, labor, capital, and entrepreneurship are added together. Gross domestic income includes wages from salaries, commissions, tips, and labor income. Rent is the income from the use of farmland, private housing, commercial stores, and facilities. Interest payments includes income from savings accounts, bonds, and other investments. Profits represent compensation derived from sole proprietorships, partnerships, corporations, and can be reported either as profits or losses from the operation of a business. Just as the expenditure approach has several components that when summed together provide us with a GDP, so does the income approach. However, this video will review income components from a higher level and address each of these components in greater depth through other media presentations. Each of these components provide specific information important to the determination of certain functions of the economy. For example, knowing how much in aggregate disposable income is available in any period can be used to estimate the consumption patterns which account for 70% of the GDP on the expenditure side. The difference between personal income and personal disposable income is the amount of income the government takes in taxes, reducing the amounts available for consumer spending. One of the most important calculations to national income accounting is the adjustment to inflationary values. The reality principle holds that what really matters to economic participants is the actual or real purchasing power of their money, of their income, and other assets, not the nominal or face value. When applied in constant dollar terms, we can assess the difference between nominal GDP and real GDP. Nominal GDP is the current value of all dollars in our initial calculation of gross domestic product. Real or constant dollar GDP is the GDP that is adjusted for inflation. In determining real GDP, we take the nominal value or our initial calculation of GDP and divide it by the price index. To illustrate the value of the adjustment to determine real GDP, assume that an economy produces only one product, laptop computers, with a market value of $500 each. In 2020, the economy produced 100 laptops for a nominal GDP of $50,000. In year 2021, the inflation rate was 10%, increasing the price of laptops to $550 each, but the production rate dropped from 100 laptops to 95 laptops. So what is the result of national GDP productivity? Is the country better or worse off than the year before? At first, it may seem as though GDP had grown by $2,250 when comparing the nominal rates. However, with the inflationary adjustment using constant dollar comparison, the economy was less productive than the year before, and the real GDP dropped by $2,500. The last measure in this discussion is the calculation of gross domestic product per capita, which is simply real GDP divided by the population. The measure is important because it provides information as to the amount of goods and services that are available to the population. It should not be interpreted that each member of the population has an equal claim on the amount of the quotient of this calculation, but rather the amount available for distribution. When the comparative number from one period to another is diminished, it is an indication that less is available for the population and the standard of living is reduced. Unless real GDP is growing at least at the same rate as the population growth, the standard of living has declined.